Hi meine Lieben, schön, dass ihr mit dabei seid. Ja, wir gucken uns heute eine richtig coole Präsentation an und zwar von Mark Matthews. Der CEO von MBH, wo ich ja investiert bin, hat ein Interview mit ihm gemacht, wo er, ich sag mal, die aktuelle Marktsituation darstellt. Und seine Hauptthese ist halt, der Tiefpunkt des Aktiencrashes war vermutlich vor 2 Wochen. Also ungefähr in dem Bereich, wo ich auch gesagt habe, das ist das Ende des Bärenmarktes, zumindest wo ich gesagt habe, ist es sehr wahrscheinlich, dass wir so langsam in der Nähe des Endes sind. Und man sollte sich jetzt langsam darauf positionieren, auf Turnarounds zu setzen, was ich ja auch gemacht habe. Jetzt müssen wir halt mal sehen, wie richtig ich da lag. Das weiß natürlich aktuell noch niemand. Ich habe die Präsentation um einige Zeitungsartikel und so, die er vorgestellt hat, gekürzt. Ich habe es gekürzt um eine Frage-Antwort-Runde am Ende. Wenn du dir das vollständige Video angucken willst, der Link ist unten in der Videobeschreibung. Und hinzugefügt habe ich natürlich meine eigenen Kommentare, ne? Also von daher, sei gespannt, ist ein richtig, richtig cooler Vortrag.
So thanks for the kind introduction, Callum. And just one clarification, I'm not the chief economist. I'm the head of research in Asia. Just because I know you're recording it. So I have, believe it or not, 103 slides. I don't think I'll get through all of them. Some of them are disclaimers, but I better get started in the interest of time. I want to say, basically, we think the bottom in the market was 2 weeks ago. And we think that there's upside from here. And there's a bunch of reasons for that. The first is that we've already gone through what I'm about to show you is one of the worst periods in markets in history, literally. The second point is the biggest reason why markets went down was, of course, the change in monetary policy due to high inflation. We believe the inflation is in the process of coming down very quickly, and that the Fed is increasingly under pressure to dial back its very hawkish stance. Another thing I want to talk about quite extensively is the dollar, because the dollar, in my mind, is the chief barometer for markets. And I think the dollar will peak and roll over toward the end of this year or the very beginning of next year in January. And the last thing, if I have time, I want to touch on the earnings, because ultimately what moves share prices is their earnings, and the earnings in the third quarter are beating expectations, and I want to make you aware of that simply because everybody was expecting the earnings to be very bad. I'll start with a little levity. This is the sort of, we thought after COVID and goodness knows what that we would return to normal, but 2022 has been anything but. And it looks pretty dark out there. But at the same time, that's been amply reflected in financial asset prices. So that's the first point I made, that I will show you right now the data, which is that we literally have had the worst year ever. And when I mean that, what I mean is if you look at the bottom right, and so there's 3 columns in each of these. That are the S&P, in other words, stocks, the 10-year treasury, and a 60-40 portfolio, which would be 60% S&P and 40% treasuries. So the returns of each of those every year since 1928. My point would be on the bottom right that this is the first time in history, first year in history, that both stocks and bonds have given double-digit losses. And you could check that out later, but literally that did not happen before. The second point, which is the years that are highlighted in yellow, is that there were only 4 years previously when both stocks and bonds were down. So barring some miracle, that will also be the case this year. And there were only 4 years on record when that happened. Now, what I would like to do is draw your attention to not the yellow ones, but the ones that came after. In other words, we've got 1931, so 1932, 41 and 42. 69 and 70, and then 18 and 19. So starting from 2018, you can see that the year that followed, a 60-40 portfolio was up 23%. And now if we look at 1969, and the year after that, 1970, the 60-40 was up 8.8%. Then we look at 1942, which came after 41, that was up 12.4. The odd man out is 1932. Following, the dreadful year of 1931, you had another negative year because of stocks, by the way. The bond market was up, but stocks and the total return was down 1.7%. Now, the point I'd like to make is 1932 was literally the worst year in the 20th century for the economy in the United States. It was the deepest, darkest moment of the Great Depression. It was also the year that FDR started the New Deal.
Ja, das ist doch mega interessant, oder? Das ist ja das, was ich auch schon in meinem Video gesagt habe, warum ich glaube, dass der Tiefpunkt erreicht ist. Habe ich auch vor ein paar Wochen, habe ich ja genau das quasi auch gesagt. Und ja, hier jetzt nochmal die aktuellen Zahlen, finde ich super interessant. Auch die Aufstellung hier mit dem 60-40 Portfolio, wie das performt hätte. Weil ja, das ja also, ich sag mal so, der heilige Gral beziehungsweise der Standard ist. Und ja, muss ich wirklich sagen, finde ich richtig, richtig cool, die Aufstellung. Und ja, wie wir unschwer sehen können, haben wir schon verdammt schlechte Zahlen. Ne? Also der Hauptgrund, den Sie jetzt genannt haben, warum wir jetzt den Tiefpunkt erreicht haben, ist, die Zahlen waren wesentlich besser als gedacht, also die ganzen Geschäftszahlen. Und wir haben einfach eine unglaublich schlechte Performance gehabt.
And even after, such a horrible thing as 1931, even being in the deepest, darkest part of the Great Depression, you actually only lost 1.7%. And so I think the downside is very limited. And at the end of this, I'll show you some more charts to illustrate that. But to come back to the point I made about the Federal Reserve and how hawkish it's been, I think, also a shock, because going into this, the Federal Reserve of 2021 was one of the most dovish on record. And nobody expected Jerome Powell, who's a very wealthy man. You can see that his wealth was well over $100 million when he took the responsibility on of being chair, much greater than any of these other people. People, thought, well, if he's got so much invested in the game, he's not going to want to destroy his own portfolio. And of course, that was absolutely incorrect. And specifically, almost a year ago, it was December of 2021, they did a 180-degree turn. And that was shown in the Fed minutes that came out on the 3rd of January, where they literally went from being uber doves to uber hawks in a month. And nobody expected that. And I think it took a while for us to realize they were deadly serious. And indeed, we can see the dark black line on the left shows this has been the most aggressive tightening cycle since 1987. Before this, we would get even more aggressive ones, which were obviously Paul Volcker in the early 80s. But over the last 35 years, this has been the fastest on record. And you can see the little red words at the tips of the others, that they typically were preceded by some crisis or another. In fact, going forward, the Fed is still committing to raising rates. So it's not like that black line is just going to stop there. They say that, by the way, this is the dot plot. So I don't remember how many dots there are in each of these. If you're good, if you've got quick eyes, you can count them. I think it's 16 or something. But basically, it's showing what each Fed official expects the interest rate to be. Both this year, which is on the left, and then you can work your way toward the right next year and 2024, etc. So I want to say that this year they're looking for the interest rates to be even lower than next year. Next year, you can see they've got them going up. Some are looking for as high as 5%. And this year and next year are kind of bunched together. And then 2024, it gets much looser. So you can see that some people are looking for rates to fall a lot. Some are looking for them to not fall at all. So there's less of a consensus, I would say. But generally, the view is the rates aren't going to come down until 2024. So we've got another at least year of high rates. And the market is pricing in a terminal rate, if you look at the top right, of about 5%, which is the upper part of the dot plot.
Ja, auch das fand ich jetzt wieder super, super spannend. Also, ja, ihr seht hier die Erwartung des Marktes, das ist das, was ich euch auch immer in meinem Morgenüberblick zeige, dass wir vermutlich so um die 5% bekommen werden. Er hatte jetzt gerade auch diese Punkteskala da gezeigt, und zwar das hier. Das sind jetzt hier die Punkte, ne? Ihr seht hier die Prozentzahl, das heißt jetzt hier zum Beispiel, da sind jetzt halt momentan 6 der Fed-Mitglieder glauben, dass sie zwischen 4,75 und 5% haben werden in 2023, aber da seht ihr jetzt so die grobe Verteilung, wie das jetzt wahrscheinlich weitergehen wird. Und was halt, denke ich, Wichtiges gesagt hat, ist, es wird nicht so sein, dass die Zinsen jetzt sinken, sondern die werden sicherlich noch ein Jahr weiter steigen. Und trotzdem geht er davon aus, dass der Aktienmarkt drehen wird. Das macht vielleicht jetzt für den einen oder anderen keinen Sinn, Aber ich würde sagen, ist sehr, sehr wahrscheinlich. Also durch das Drucken dadurch, dass das Geld mehr wert wird, können natürlich auch die Aktien quasi fallen. Aber irgendwann sind die Aktien halt so weit gefallen, dass obwohl jetzt das Geld quasi relativ konstant ist vom Wert, allerdings momentan baut es ja noch ab, wir haben ja immer noch ein inflationäres Szenario, ja, dann ist es halt irgendwann so, dass das drehen muss. Ja? Das heißt dann halt wirklich, dass dann der Aktienmarkt wirklich sich anpassen muss und der Aktienmarkt wird natürlich drehen, bevor der Marktcrash wirklich durch ist.
Beyond that, some people are going way out on a limb and saying, why couldn't it be way higher? I mean, Volcker took it to 13. Why couldn't Powell take it to 13? So the Taylor rule is a way of estimating what the correct policy rate should be based on inflation and several other barometers. And you can see the light blue line shows that according to the Taylor rule, we should be possibly up as high as 13%. And Bank of America put this out here just to really show that we're way in the deep end with this, because unless you're 80 years old, you didn't go through something like this, because you'd be retired by now if you'd been in the market back in 80, 81, 82. There are side effects, and so one is the financial markets. And Bank of America has a credit stress indicator. It is just below the level where dysfunctionality occurs, and of course we've seen Credit Suisse and the pension funds in the UK. And as Warren Buffett said, when the tide goes out, you see who's been swimming naked. So there's surely more than just two. The second thing is good old-fashioned recession. So this is the yield curve between the 10 and the 3-month Treasury yields, and it went negative last week. And if you look back in history, the gray bars are the recessions. So it was followed by a recession in every instance since the 1970s, albeit with a very long lag. You can see on average a 24-month lag. This time, I think, has been so unusual that it's very difficult to know if the yield curve is still has this good predictive quality. And maybe if it does, the lag would be much shorter than it has been on average in the past. We don't know. But there are clear signs that the economy is slowing down. Apple just said they're reducing the amount of iPhone 14s that they plan to make, for example. And so there's a lot of pushback. There's a lot of pressure on the Fed. And I won't read through every article, but I'll just show you that, for example, the former chief economist at the IMF said that central banks are underestimating the speed that inflation is going to fall as their economies slow. They're all raising rates at the same time. It's going to make a big problem. Here we've got the top diplomat at the EU, Joseph Borrell, and he said that other central banks are being forced into raising rates to protect their currencies from being devalued, and that makes life much more difficult for countries that have to import things. But this synchronicity of central banks is unlike anything seen in 50 years and could also cause a recession. Here's Greg Mankiw, economist at Harvard, and he said, this is what was her name? Abby Joseph Cohen used to say in the 90s, super tankers. So he said that steering the economy is like steering a large ship. Move slowly. Once you return the hell to normal, it keeps going because it's such a big ship. So don't overdo it. And at the bottom, a prominent and powerful liberal lobby group in Washington, the Groundwork Collaborative. So here's a representative of the Groundwork Collaborative saying that this is like the proverbial pot slowly boiling, and the frog that's sitting in it doesn't even know it's boiled until it's over. And so she's saying that about the economy this time. And last but not least, Jeremy Siegel, one of the very famous business professors, saying that he thought the Fed did far too much stimulus in 2020 and 2021. Now it's moving far too much in the opposite direction. You can see at the bottom, he said, I see inflation going down everywhere. And the Fed saying they're going to be tighter for longer means a deep recession. Actually, that's not the last one. The last one is Ed Yardeni. He's another old timer. He was a Fed economist in the 1970s. But you can see at the bottom, he says, I'm totally stumped, mystified, surprised that officials at the Fed don't acknowledge that raising rates so much, quantitative tightening, and soaring dollar, you put all those together and you're asking for a big problem. And so he said that he just sees one more rate hike coming, which would be at the next FOMC on the 4th of November. And then that's it, because between now and then, financial stability will pop up as a primary concern. Actually, he said that back on the 3rd of October, and that was before Credit Suisse and and the BOE, etc. What I would say is that normally I would agree with Mr. Yardeni were it not for politics. And the problem is that here's why I want to show you why I agree with him. Definitely inflation is going to come down. The problem is that there's two lines here. The first is the actual inflation rate, which is the purple line. And the second is Citigroup's inflation surprise index. So the inflation surprise index has collapsed. In the past, it has led the actual inflation very nicely. This time it will too. But the average person on Main Street, the average American, they don't see that light blue line. They just see the purple line, which is still very high. And so for the Federal Reserve to declare victory now with inflation stuck way up there where it is on the top right would just look very politically incorrect. And it would be asking for trouble for the White House as well, and for the Congress, which is about to have an election. But what I would say, this time it will too. But
Ja, das sieht auch mega interessant aus. Das heißt, es gibt wohl irgendwie hier ich vermute mal von der Citibank, einen Index, der prognostiziert, wo das Ganze hingehen soll und der vorne wegläuft. Schaut euch das mal an. Also hier seht ihr, das, was jetzt angesprochen wurde, ist, dass der jetzt halt richtig abgeschmiert ist und deswegen davon ausgegangen wird, dass die Inflation jetzt halt auch dahinterherläuft. Gucken wir uns das mal an, wie das vorher war. Jetzt hier zum Beispiel lief der eher nach, ne? Also hier 2014, 2015 lief der hinterher. Hier lief er quasi mit. Hier war es auch so, dass er eigentlich mit dem Kurs gelaufen ist. Ja, es wirkt, finde ich, so, als ob der so ein bisschen übertreibt hier, der blaue Index. Ne? Ihr seht das hier, dass der häufig nach unten so wegschlägt. Und das haben wir jetzt halt auch. Das heißt, wahrscheinlich geht es hier oben ein bisschen runter, allerdings nicht so stark, wie der das jetzt hier prognostiziert. Allerdings, dass der jetzt da wirklich so, also hier sehen wir, da hat es mal schön geklappt. Ne? Da seht ihr, dass der Index hier wesentlich stärker abgeschmiert ist, als jetzt hier in dem Bereich. Das ist auf jeden Fall ganz interessant. Also das wäre auf jeden Fall jetzt ein Indikator dafür, dass die Inflation jetzt bald stark zurückgehen wird. Und ja, das deckt sich ehrlich gesagt auch mit meiner Einschätzung.
Is that I want to show you a few things why inflation is coming down. And the first is that there's two main components, flexible and sticky. So the sticky stuff is the problem. It's the blue line that's going up there. It's actually the highest since the early 80s. But the flexible, which was responsible for the lion's share of the inflation, it clearly peaked and it's coming down very fast. And for example, we can see global freight rates are down about 80% from their peak. And so the supply chains are normalizing.
Auch das für uns als Aktionäre sicherlich sehr, sehr interessant, ne? Weil das natürlich jetzt hier bedeutet, dass wir hier, ja, wenn die Frachtkosten so runtergehen, dass halt diese ganzen Investments wie jetzt Hapag-Lloyd und so weiter und halt auch die ganzen anderen Logistikunternehmen wahrscheinlich in Zukunft halt nicht mehr so gute Zahlen schreiben werden, wie sie die jetzt in der Vergangenheit hatten. Also ihr seht ja, die Kosten waren ja komplett explodiert. Wenn ich das hier richtig sehe, ist das hier oben 10.000 US-Dollar und jetzt sind wir wieder bei 3.400. Also ja, hat sich quasi wieder gedrittelt und wir sind jetzt wieder fast auf, ich sag mal, einem regulären Niveau. Ne? Das heißt jetzt, wenn du jetzt investiert bist gerade in diese ganzen Logistikunternehmen, wäre eventuell ein Zeitpunkt, um jetzt vielleicht noch halbwegs günstig dort auszusteigen.
And we can see therefore the purple line shows you backlog of work is falling, and the brown line shows you delivery times are improving. And so that means prices are starting to come down. You might remember that during COVID, because of the shutdowns in factories and all the ports and the containers were taken offline, that there were no new cars for a while, also because of absence of semiconductors. And so people had to go about and buy new cars. And at one point last year, around this time last year, new car prices were rising at about 50%. Now, actually, they're down 10%. It's the biggest they've dropped ever in the history of this series. So if we back it up, we rewind the clock and look what happened prior to COVID over on the left. Services were where the inflation was coming from, and you had almost no goods inflation because of China, globalization, technology, etc. Then what happened is you had this big hump with the blue going up, with COVID, with lockdowns, with supply chain disruptions, etc. And that's now going down now and will continue to go down. But what the baton has been passed to the services. Services are the problem. And really, the biggest one is what you can see on the left, shelter, which means property. And the Fed measures that primarily through rent. So a third of the CPI basket is basically property.
Guck mal, das ist doch auch sehr interessant. Da seht ihr jetzt einmal, ne, die Aufteilung des CPIs, also des Consumer Price Index. Und da seht ihr, dass halt 33% des Consumer Price Index über Miete abgedeckt wird quasi, also über Hauspreise im Endeffekt. 7,54 ist Energie, 14% Essen. Also insbesondere, was mich halt ehrlich gesagt gewundert hat, sind diese 33%. Ja, ich weiß nicht, hast du das anders eingeschätzt? Hast du gedacht, dass die auch wirklich 33% sind? Ja, ist auf jeden Fall eine richtig coole Präsentation. Ich bin froh, dass ich die Kamera angemacht habe.
And I think it's going to go down. So the first thing is that the mortgage rates have gone up a lot. That's on the right-hand side of the chart on the top. They've doubled, in fact, more than doubled. And so mortgage applications are falling. A house that cost $600,000 last year, you only had to pay a 3% mortgage rate for. And so assuming a 20% down payment, you were paying about $2,000 a month. That same house is worth a little less now because prices have peaked, as I'll show you momentarily. But your interest rate now, if you're getting a 30-year fixed interest rate, is 7%. And so your monthly mortgage payment will be well in excess of $3,000. Another way of looking at it is that the current cost of getting a mortgage now, assuming a 20% down payment for the average home, is the equivalent of 95 hours of wages a month. The average American works 136 hours a month. So that's basically 70% of their salary. So if you had a double income, you could cut that in half, obviously, but even 35% is still much higher than the golden rule for a mortgage, which is that it should not exceed 28% of your income. So prices are coming down. The red line is prices so far this year, and they are down about 6% from their peak in June. And I think they're going to come down more for a bunch of reasons. I can show you, first of all, when we look at the homes that are listed for sale right now that have seen price drops in the past month. That's the red line for this year, and it's rising quite quickly. You can see in the previous years it didn't go up much. People didn't have to cut their prices to sell their homes.
Okay, das heißt, die Verkaufspreise sind jetzt um 7,9% gesunken, während ja, in der Vergangenheit das eher anders war, wenn ich das richtig verstehe. Also das ist ja der Price Drop, also der Wertverlust, wenn man so will, ne? Und ja.
In fact, there are quite a few cities where the home price is down in excess of 10% from where it was in May. Oakland being a suburb of San Francisco, San Jose, capital of Silicon Valley, Austin, fourth largest city in Texas, Seattle, San Francisco, Washington, D.C. So you can see that. And this shows you the traffic of prospective buyers to visit homes for sale has collapsed. So that's another signal. Survey asking, where do you think house prices are going to be a year from now, higher or lower? So most people saying very unlikely they're going to be higher. And it takes a few months, it takes about 6 months at least for lower property prices to feed into lower rents. But ultimately they do correlate because landlords base the rent that they charge tenants off of the value of their property. So rent prices on a sequential basis have been dropping for quite a few months in a row. This is according to Zillow, but you can see it's not in negative territory yet, according to Zillow. But according to apartments.com, actually, most of the 40 metro areas in America did register negative asking prices in the month of August over the month of July. And that's only up until August. So I'm pretty sure that September, when it comes out, will also be negative. Anyway, we do a model where we compare property prices with the rent component of the CPI basket, and backtesting that, it does show that that component of the basket should come down quite quickly. I just also want to touch very briefly on surveys, which are showing a similar story. So University of Michigan has one of the biggest consumer sentiment surveys. Expectations for inflation, both 12 months and over the longer term, are rolling over and coming down. New York Fed does a similar survey, rolling over. And if we look at the prices paid in the Manufacturing Purchasing Managers Index, the prices that companies say that that they're paying for goods, that you can see on the top right, it's rolling over, and that is a pretty good relationship with the actual headline CPI, which is on the bottom. The Fed also has said that they think the labor market's too hot and they want it to cool down, and it is. And what we see is job openings divided by unemployed workers. And so that peaked and it's coming down. But those job openings, there's probably less of them than the official numbers show, because often when companies are advertising, they'll advertise in 4 different places, or when they've hired the person, they don't bother taking the ad away, et cetera, et cetera. But the job market is strong. I'm not denying that, but it's softening. So I want to just say that we think inflation is going to come down, and those are the charts that I wanted to show you to illustrate why.
Ist das nicht verrückt? Es gibt 1,7 Jobs für jeweils eine Person, die keinen Job hat. Na, da sagt mal einer, dass man nicht arbeiten kann.
But as for the actual Fed funds rate, the interest rate, and when does that peak? Really, the canary in the coal mine historically has been the 2-year Treasury yield, which a year ago was at 0.5%. And this year it is at 4.5%. So that's pretty much the fastest move on record. And if we look back at previous tightening cycles, which are the y-axis from the top to the bottom on the left, what you can find is that usually, not always, there were 2 that it didn't happen, but usually the 2-year Treasury will peak a few weeks before the Fed goes on hold. And so let's just watch the 2-year Treasury. But my best guess is that the Fed will go on hold not next month, because that, as I showed you, inflation is still too high. But if we get a decent move down in inflation for the month of October, which is obviously the month we're in now, and that reading would come out in November, then I think in December, there's a good chance that they could say, you know what, we think we can start taking it a little bit easier. And there's already some cracks in their armor. For example, last week, the vice chair, Lael Brainerd, said that, I'm just going to quote some of the things that she said, "We'll be learning as we go, and our assessment will reflect incoming data, both globally and domestically." And I'm just going to continue reading. She said that we're aware that there are cross-border effects of the movements in interest rates and exchange rates. So clearly acknowledging the skyrocketing dollar and the fact that interest rates are going up around the world and worsening balances. And she said the Fed's dot plot is very helpful at a point in time, but things can change. I think that's quite an important statement for her to say things can change. And then Chicago Fed president there on the bottom saying front loading was a good thing. In other words, I'm glad we raised rates really, really quickly, but overshooting is costly too. That's what he said. And so you might say, well, they can't just go from black to white in one meeting, but actually they can. They did it in January. And I just want to show that the Reserve Bank of Australia did so. That's what they did this month. So if we look at the policy statement in September, they were saying, oh, global factors explain much of the increase in inflation. Domestic factors are playing a role. There's still widespread upward pressure on prices from strong demand, tight labor market, capacity constraints, quite bearish. Now we can see in October, a few weeks ago, they said, well, there's uncertainty in the outlook for the global economy. It's deteriorated recently. Household spending is responding to the tighter financial conditions. Dovish, and actually they were supposed to hike by 50 basis points. They only did 25. I think that was probably the last, because we also see that property prices, particularly Sydney over on the left, have been falling quite a bit, which is what they wanted to see. So basically, inflation is coming down, and the Fed will go on hold. That's the central message I want to communicate. But I also said that I wanted to spend some time on the dollar. So once again, to inject a little levity into it, can you make it in dollars? The robber's asking the cashier. Sometimes when you see something like a cartoon, it's fun, obviously it's funny, but it's telling you that this is something that a lot of people have already got in their psyche, that the dollar has already gone up a lot. And so That's in my mind actually a rather significant thing that we're getting cartoons about the dollar, which we don't usually. But the dollar is profoundly negative for asset prices, and as a case in point, over the last 12 months, what I've done here is I've just turned the dollar upside down. So the blue line actually is going up, but I've inverted it to show you that particularly over the last 12 months, we've had a very strong inverse correlation between the dollar and global stocks.
Das ist ja witzig, ne? Also, was hat er gemacht? Er hat die Wertentwicklung des Dollars umgedreht. Das heißt, eigentlich geht der Dollar nach oben und hat geschaut, wie verhält die sich im Vergleich zum MSCI World. Und wir sehen halt wirklich, dass der MSCI World ja genauso gelaufen ist wie der US-Dollar. Also wie der inverse US-Dollar. Vor allem guckt euch mal das hier an, hier dieser Peak zum Beispiel, ja, wie perfekt diese Peaks hier übereinander gelegen haben oder auch hier, oder hier. Schon beeindruckend. Ich weiß nur nicht, was man daraus machen soll. Also der Wert des Dollars, ja, und der MSCI World. MSCI World hat ja zu 60% US-Aktien drin. Von daher würde ich mal sagen, ist es auch irgendwie logisch. Allerdings 40% sind halt auch nicht US-Werte.
And we can also see in the US stock market, companies that have foreign exposure that drive most of their revenues from overseas have underperformed those with US exposure because the dollar's been strong. And 40% of S&P revenues do come from overseas. So dollar is critical for stocks. And here I want to say that we've had a 45-degree angle for the better part of this year. And let's just watch that. If it rolls over, that's extremely positive. And if it doesn't, it's not good. But it has been the strongest dollar, at least in the last 20 years. You can see all the gray lines or the seasonal average of what seasonally what the dollar's done. I mean, there's no real average there. It's all higgledy-piggledy. But you can see the black line shows you quite clearly that the dollar has been the strongest this year that it has at any point in the last 20. And now, instead of looking at it on a seasonal basis, what I want to do is show you the 12-month rolling average of the dollar going back to 1982. So that's to say today's dollar price divided by where it was a year ago. And then you do the same for yesterday versus yesterday, a year ago, et cetera. That's a 12-month moving average. And we can see that it's at 20 now. So the dollar is 20% higher than where it was on the 20th of October 2021. And that has not happened often before. You had the Plaza Accord, the global financial crisis, and when the Chinese devalued the yuan in 2015. And yes, the dollar did go higher, but it didn't last long. And then it was sort of like a parabola, you know, that went right back down very quickly. And my sense is that could happen this time because 2/3 of the dollar index is the euro. And the Europeans have an even bigger inflation problem than the Americans do. Theirs is running at about 10%. So we think, if you look at the chart on the left, that in January, the baton will be passed, so to speak, from the Fed to the ECB, and the Fed's tightening will be largely done, whereas the ECB will start tightening more. And when you raise rates more than your peers, typically your currency will appreciate. And so on the right, we are looking for the euro to stabilize and then rebound in the beginning of next year.
Das war ja auch spannend, ne? Also er geht davon aus, dass der Euro in nächster Zeit steigen wird, weil die EZB wesentlich stärker die Zinsen anheben muss als die Fed. Also haben wir noch einiges vor uns.
I mentioned cartoons and their utility is just sort of a contrarian indicator. The front page of magazines is similar. And here's the front page of Business Week in 2019. Is inflation dead? Well, we know what happened. Here's the front page of the same magazine 3 weeks ago. And here's the same, not the same magazine, but here's Barron's 2 weeks ago. So, you know, I put that out partially in jest, but not entirely. Because everybody knows the dollar's been strong, and in fact, it's very expensive. So the most simplistic way to value a currency is purchasing power parity. How much does something cost, like a Big Mac, for example, in New York? How much does that same Big Mac cost in London or Singapore or Tokyo or wherever? And so we can see on the far right that the dollar is very, very expensive using purchasing power parity compared to other major currencies in the world. I would also say that I did mention the dysfunctionality that's starting to occur in financial markets, and we saw a taste of that in the UK. It is early days, but it looks like the market likes Rishi Sunak, and the pound's volatility is decreasing. I think I'll just leave it at that because I'm not entirely sure. And I did point out in the text above that it's shocking but true. Britain has $118 billion in foreign exchange reserves, which is about the same as Malaysia. Singapore has almost 3 times as many. Hong Kong has 4 times as many. But I'm going to sort of round off with the markets. And here's the S&P. And at the bottom right, you can see what we think is the beginning of a floor. And we think, as I said, that happened 2 weeks ago. We want it to go sideways, actually. We don't want it to go whipping back up. Because when you go sideways and you build a horizontal base, you build a nice foundation, like a house. You put in a solid foundation, and then you can build on it. If all of a sudden it's a V, you don't have that same technical strength. But I would point out technically that it's very important. The S&P, now we're looking at a much longer term chart, bounced nicely off its 200-week moving average, because when you go below such a long-term momentum indicator like we did on the bottom left in the global financial crisis, then the bottom falls out of the market. But we bounced very smartly off of that. Valuation wise, we're on 17.5 times last year's earnings, which is the red horizontal dotted line running across the middle of this chart, showing you the price earnings ratio going back to 1960. That actually happens to be exactly the average since 1960 of the stock market's trailing price earnings ratio. So I don't think we are expensive, and I don't think we're cheap. I think we're just fair value, frankly. But what people want to know is not trailing earnings, they want to know about future earnings.
Guck mal, das ist auch spannend. Das ist ja auch das, was ich mir immer angucke in meinen, in meinen Videos, ne? Wo wir uns das Kurs-Gewinn-Verhältnis, oder jede Woche gucke ich mir das Schiller-KGV des S&P 500 an. Und hier sehen wir jetzt halt auch das Trading Kurs-Gewinn-Verhältnis, und da sehen wir jetzt, dass wir halt wirklich in der Höhe des Durchschnitts angekommen sind. Dementsprechend denke ich, wenn wir jetzt mal einfach davon ausgehen, dass jetzt die Gewinne gleich bleiben und die Kurse vielleicht noch weiter fallen, dann sehen wir, dass wir jetzt hier so in so einem Bereich sind, so ungefähr um, so 14, ein Faktor 14 rum. Ne? Das heißt, das wäre, denke ich, so das Schlimmste, was passieren könnte. Jetzt gerade sind wir so bei 18. Dementsprechend könnten wir 4 Achtzehntel noch runter. Und das wäre halt ein Absturz von der aktuellen Position um 22%, so mehr oder weniger, als Worst-Case-Szenario. Also recht entspannt, ehrlich gesagt.
The good news, I would say, is a little bit like the magazine indicator, magazine cover indicator. Everybody already thinks it's the end of the world. So if we look at Bank of America surveys fund managers, and one of the questions they ask is, do you think profits will improve over the next year? And really a record number of them say, no, I don't think so. So in other words, they already expect the things to be lousy. They won't be surprised if they are. And actually, I don't think things will be as lousy as they make them out to be, because the analysts have already downgraded the third quarter by 8%, which if you look at the bottom right is the little gray diamond, X energy. You see it says minus 8%. And that's the downgrades of third quarter earnings that the analysts did during the third quarter, which you can see, apart from the pandemic, pretty much the biggest cuts that they've done pre-earnings season. And so now we're in the middle of the earnings season, and 20% of the S&P companies have reported. Lo and behold, they're beating expectations by 72%. Which is, I admit, below the average of the past 5 years, which is a 77% beat. And I'm sure you've heard this one before, but companies intentionally lowball their earnings going into results so that they can beat them, and then they look really good and their share price goes up. But so it's not 77, but it's still 72, which is far higher than I think anybody had anticipated, because everybody was looking for massive margin compression due to inflation. It just has not happened. We do have the big tech stocks reporting this week, so we'll watch those closely. My sense is they will beat expectations. But it is a bear market, and typically, if you look at the second row from the bottom, bear markets last longer than this one. This one is 195 days and down 25%. Typically, bear markets are down 38% from top to bottom, and they last 318 days. At least that's since 29. So you must know that the sentiment is still, look, it ain't over yet, because there's all these problems, tides going out, Fed's hawkish, da da da. I would say some of it depends on the economy, because if we look, this isn't since 1928, but this is since 1945. When you have a recession, on average, the bear markets are more severe, and that's totally intuitive. So on the bottom, is there a recession? That's the table on the bottom. Then on average, you go down 34.8. If you don't have a recession, on average, you go down 23.8. What I would say is that I won't discount the fact that it could be a recession. Our own house view is, for the time being, that in the United States, there will not be one. But if there is, our view is it'll be very mild, because the labor market is so very strong. And we've been really surprised by the resilience, the ability of the consumer to withstand these major price increases. And that's been shown in the results that are coming out from companies, actually, that they're, I just showed you their earnings, but their revenues are beating expectations too. And generally the mood on Main Street is not that bad. So that could change, but for now, at least, I would say if we have a recession, I wasn't around in 1948, I wasn't around in 1956, I was around in 1990. I remember that one. And in 1990, the market went down 19.9%, the savings and loans crisis and first Gulf War. It lasted about 7 months, and it wasn't that painful. And I think that if we get a recession today, it'll be something similar. Frankly, we've already factored it in, because we're down, in excess of 20%. A few other things I'll show you on the market are, first of all, this is among the worst years on record for the first 9 months of the year. And if you look at the subsequent performance into the end of the year, with the exception of the global financial crisis, there was a rally. I would also point out that since 1932, the month with the most major market bottoms, in other words, end of the bear market, was the month of October that we're in now. And since 1950, we can see that on average, the best months of the year are toward the end of the year. So we only have, actually, I should update this slide. There's 12 weeks left this year. And 5 of the 10 best weeks on record, on average, since 1950 are actually in front of us still. I can also illustrate that pictorially here with the returns in October, November, and December on average since 1950, and also on average over the last 20 years, over the last 10 years in green. But importantly, in midterms, which is like the one we're in now, we're in a midterm election year, that's the black bars. And then you get very nice returns. Now, I'll just say with the midterms, the betting websites are thinking the Republicans might win the Senate. They will definitely win the House, but now it's looking like they're going to win the Senate too. Stock market's telling us that as well. Stock market, this is a brokerage called Strategas, and they have a portfolio that would benefit from a Republican Senate, or a portfolio that would benefit from a Democrat Senate. The Republican one's going up and the Democrat one's going down. So the market seems to think the Republicans are going to win. Regardless of who wins, typically, this goes back to 1928, in a midterm election, you have sideways performance for the 12 years leading up to it, and then you have quite strong returns in the 12 months after it. Just an average, but for whatever reason, I think people don't like the political uncertainty going into the midterms, but also usually the White House incumbent, their party loses the midterms. And the market likes it when you have a divided government, because I think the logic is that you get less fiscal stimulus, therefore less inflation. And also the politicians are so busy bickering amongst each other, they can't create layers of red tape and whatnot to get in the way of the corporate sector. The retail investors are very bearish, so we can see the ratio of puts to calls. The blue line at the bottom is at 3 times. There's 3 times more puts than calls for odd lot investors, which is the highest on record. You can also see in the past when you got big spikes in the put call ratio, it tended to coincide with the market bottom. Institutional investors, well, I should say, no, this is still retail. American Association of Individual Investors does a survey. Are you bullish or bearish? the percent saying they're bearish is the blue line on the bottom, and it's basically the highest on record. I think if you look in the middle, global financial crisis got a bit higher, but once again, when you get to that dotted horizontal line at the top, and you just look at where that was, commensurate with the S&P, it tended to correspond with bottoms in the S&P. Then on the institutional side, Bank of America, as I said, does a fund manager survey. So I showed you one slide earlier, what percent think the global profits will improve, and it was like none. Here we can see similarly, their fund managers surveyed see more risks than even in the global financial crisis, which is a contrarian indicator. I mean, it means they already see massive, massive risks. They're already very, very bearish.
Das ist doch auch spannend. Also, wer war das jetzt? Die Manager, die Fondsmanager sind sehr, sehr kritisch. Ne? Ihr seht das hier, das Risiko, also sie sehen komplettes Risiko im Endeffekt, wenn man so will. Und das heißt halt, er meint ja gerade, das wäre ein konträrer Indikator. Ne? Das heißt, wenn ihr Geld investiert, also wenn der sehr hoch ist, dann ist das ein Zeichen dafür, dass die Aktienmärkte eher steigen, weil das natürlich bedeutet, dass sie extremst aus dem Markt rausgegangen sind. Und wenn der Markt jetzt anfängt zu drehen, dann müssen die alle wieder reinkaufen und dann feuern die natürlich das Ganze wieder an. Ne? Also von daher durchaus, finde ich, ein sehr interessanter Aspekt.
And the percent expecting a stronger economy, which is really down here in the dumps on the bottom right. If you look at that alongside the stock market, which is the light blue line, you'll see the red circles that only in one occasion, once again, I go back to the global financial crisis, July 2008, was a bottom in the percent expecting a stronger economy 12 months forward. And yet the market continued to go down after that. But all the other times, basically, that was the bottom in the market as well. So if we get a Lehman Brothers, yeah, we're going to go lower. If we don't get another Lehman Brothers, I think we're going higher. I don't think we're getting another Lehman Brothers. On interest rates, here is the same fund managers. Now, back in, I don't know, June, no, maybe it was back in May or April, 6 months ago, we can see the percent who felt that interest rates would be higher 12 months from now was at 90%. Still, there's a lot more who think rates will be higher 12 months from now than lower, but it's gone from 90 down to 70. And you can see that the percent thinking lower was gone from 0 to 30. And clearly those lines are moving, toward each other. So the street is also increasingly starting to think, you know what, I think the Fed is going to pause. And I'll also show you here, Bank Credit Analyst does a capitulation indicator. I put here what the things are in it. But essentially, we are where we were before Lehman. If we get a Lehman, we go lower, but otherwise, we shouldn't really go lower than here because we never have before. I'm rounding off, but I'll just show you each dot here is a year when the S&P was down from the previous 12 months. So the 52-week high. 52 trading, 250 trading days a year is 52 weeks. So each dot just shows you years when the S&P was down from its 52-week high. What I would simply say is where we are now is the red vertical line. So actually that was where we were a couple of weeks ago. The actual absolute bottom in the S&P was on the 12th of October at a minus 25.4% drawdown. That's that vertical red line. And if you just kind of eyeball the other little dots that are on that line, or maybe over to the left of it, basically very, very rarely were your returns 1 year later, and that would be the y-axis from the top to the bottom over on the left. Very, very rarely were they negative. That would be that lower left quadrant. We can literally count them, whereas all the other dots is pretty hard to count. So I could just tell you, because I don't want you to waste your time counting them, that when you got to minus 25%, which is that red dot in the middle, your chances of being up later, 1 year later, were 80%. Let's say I'm wrong and it goes down another 10%, so we go down 35%. If you look over to the left, when you hit 34%, your chances of being down 12 months later are 0. 100% of the time it was higher. Another thing I would just say, you might know Kathy Woods and her ARK fund. Well, that's down 78% from its peak, which is interestingly exactly the same as the NASDAQ went down from its peak in 2000 to 2002. And the last thing I'll say about the stock market, just to sort of poke fun at one of the big bears, is whenever they bring Nouriel Roubini out, you always know you're getting close to the bottom. Because he got one great call, which was the global financial crisis, but literally every year since then, he's been also calling for, the end of the world. And so far it hasn't happened. So the fact that the media are bringing out Roubini again, to me, is a strong signal. I will touch on Asia very briefly before I wrap it out. I'll simply say that the yen is down 35% from where it was a year ago. I think it's a tremendous buy. I don't know if it's the bottom, but Japanese assets are fantastically cheap. We put together a basket of companies that we think are very high quality, because most of Japan I actually wouldn't touch, and I'm happy to tell you in more detail after the presentation. But there are some companies that are world-class. These are some of them. There's like over 7,000 listed companies in Japan, so it's a big universe, but I've only put in around 12 here.
Das ist mir auch schon aufgefallen, dass die japanischen Aktien wirklich, wirklich günstig sind zum aktuellen Zeitpunkt. Meint ihr, wir sollten mal ein Portfolio aufsetzen mit Japan-Aktien? Schreib mal in die Kommentare, ob du da Interesse daran hättest.
When we run that, even dollarized, including dividends, it has outperformed the S&P over the last 5 years. It's the blue line. The S&P is the brown line. Pretty hard to outperform the S&P. Very few indices can do it. So quality Japan, I think it's a great time to buy some quality Japan. China is just a huge tragedy. If we rewind the clock, we had a NASDAQ in Asia. It was, JD.com and Alibaba and Netflix and Tencent and Meituan, etc. So it had this closed ecosystem, internet ecosystem that 1.4 billion people were using, and they couldn't use Google and they couldn't use Facebook. And what happened was, I think that a bunch of things. These companies were putting pressure on moms and pops, on society in general. They were getting very rich. Jack Ma at his peak was worth about $70 billion. Their data was far superior to the data that the government had, and a bunch of other things. So there was a massive crackdown, which was actually right after Jack Ma gave his speech in November 2021. So actually somebody realized Xi Jinping really does read everybody's speeches, and he tends to have a bit of a temper. So I think that it's not a coincidence that the big crackdown came just a few weeks after Jack Ma's speech, but it came. The other thing, though, I think, is that this policy of common prosperity, wealth redistribution, Chinese modernization was the big term used in the Congress last week, basically is a response to the disastrous demographics of China. And the cost of raising a child is more expensive in China than almost every country in the world. Consequently, I read a survey a few months ago, 45% of young women in China say they do not intend to get married. So they're not going to have kids. The birth rate is this. So the average age in China is 38, which is, by the way, exactly the same age in America. 38 is the average. But in 30 years, the average age in China, demographers say, will be 56, and America will be 44. Now, there's also the fact they didn't remove the zero COVID. And what I would say there is some anecdotal evidence that they're probably moving in that direction. So I think it will come off little by little, but won't be really enough to get the economy going. The stock market has been totally derated. Alibaba, which used to have a price to sales ratio 3 times larger than Google's, today has the same price to sales ratio as Campbell's Soup. In other words, it's never going to have any growth again. Is that true or not? I think, frankly, as long as this policy and this set of government remains in place, probably is somewhat true. And then you've got the fact that China's stock market, not just China, but many Asian stock markets, are very weighed down by the deadwood of state-owned enterprises. So this is just the top 25 of the 50 largest companies in China. The red ones are the state-owned companies. But if you add them up, they're actually a quarter of the index. And they're not run for minority shareholders. They're run by civil servants who are not, paid really based on their performance. So I would just say China's a macro trade. When we see the government bond yield rise, that'll be a sign that better times are ahead, because the bond would be rising in response to, better economic conditions, probably through stimulus. But there's no sign of that happening in the bond market right now. And I would just say, in conclusion, that the saddest thing for me is Hong Kong, because this is a 30-year trend line, and it was broken yesterday. So Hong Kong, even in the Asian crisis, even Tiananmen Square, even, I don't know, global financial crisis, it always managed to avoid breaking this line, but it did it. And so this is, in my mind, actually the a stock market in the world with the most distressed prices, because it's trading on 0.7 times book, which it never did if you look on the left in the Asian crisis, never did in the global financial crisis, but it did. It has done that now. I don't really know what more to say about it, except that it is extremely undervalued. And there are some good companies in Hong Kong that are not China plays, like an AIA or a Samsonite or a Hong Kong Telecom, the REITs, and they are very, very cheap. That's what I'll say. But I would say that you can always gauge, I think, the return on capital of a country by watching what its rich people are doing. And I'm interested, but also sad to see that Tencent has made hardly any investments in China this year. They've made 27 overseas, and they say they're reorienting their M&A strategy to focus more on overseas. Frankly, Southeast Asia is not that much different. This is the largest department store in Thailand, Central. They just announced they're going to be spending $1.3 billion in Switzerland, Austria, and Germany. And no offense to Switzerland, but when Thai billionaires think that it's got a better growth prospect than their own country, that's really telling you something. But I will end on a happy note, which is to say that India, Tata Group, largest company in India, are investing $90 billion in India over the next 5 years. They have spent the last 20 years trying to get out of India. They bought everything from Tetley's tea to Range Rover, Land Rover, Jaguar, steel companies in Korea, just everything. It was sort of messy. But now they're coming back to India to build high-end things, electronics factories, semiconductors.
Okay, also er sieht China als eines der günstigsten Investments zum aktuellen Zeitpunkt. Auch da stimme ich ihm auf jeden Fall zu. Ja, also Japan halt als so ein bisschen konservativere Variante. Und China, ich habe keine Ahnung, wo diese Preise noch hingehen sollen und weiß auch nicht, was da ehrlich gesagt eingepreist ist. Ich halte die Bewegung für total übertrieben. Ich bin ja vor ungefähr einem Jahr in China reingegangen. Damit bin ich natürlich ziemlich auf die Nase geflogen. Weil ich dachte, okay, so günstig waren die ewig nicht und es stimmte auch, meine Analyse war da nicht falsch und die Dividenden, die ich da kriege, zum Teil von 40%, die sind schon echt immens und da sieht man halt einfach die Riesendiskrepanz zwischen den fundamentalen Werten in China und im Endeffekt dem Preis, den man aktuell bezahlt. Aber es ist natürlich auch mit einem recht hohen Risiko verbunden und jeder muss natürlich immer überlegen, ob es ihm das wert ist oder halt auch nicht.
And by the way, Apple are moving iPhone 14 production to India. They have made iPhones in the past in India, but they never made the latest model. And you can see at the bottom, JP Morgan think that by 2025, 1 in every 4 iPhones in the world will be made in India. So I'd be happy to speak more at length about India or any other place you'd like, but I should finish it off here. So I'll just exit.
Mensch, das war ja mega, oder? Also, ich fand's großartig, tolle Präsentation, schön vorgetragen, viele interessante Aspekte. Ich muss mir das nochmal ein bisschen genauer angucken. Ich denke, da waren einige Indikatoren dabei, die ich mir so noch nie angeguckt habe vorher. Das heißt, die werde ich auf jeden Fall in mein Setup aufnehmen für die Aktienakademie, um die Märkte besser bewerten zu können. Da wird bestimmt das eine oder andere jetzt noch dazukommen. Also bin ich schon sehr gespannt. Ja, ich hoffe, du konntest da jetzt einiges draus mitnehmen. Also für mich war es wirklich interessant, ja. Also sein Ausblick auf China war halt eine Riesenchance, also eine super Unterbewertung, allerdings halt auch ein hohes Risiko, dass einem eventuell die Assets eingefroren werden, wenn es um Taiwan explodiert. Ja, das werden wir jetzt mal beobachten müssen und seine Prognose war ja 30-40% gehen die internationalen Aktienmärkte in den Keller, wenn es dazu kommen sollte, dass jetzt wirklich dort ein Krieg stattfindet. Das halte ich natürlich für sehr, sehr realistisch, dass genau das passieren würde. Allerdings ist es halt aktuell sehr, sehr unklar, ob das denn passiert, ja oder nein. Für mich war es auf jeden Fall richtig spannend und ich hoffe, du konntest auch ein bisschen was daraus mitnehmen. Also, pass auf dein Geld auf und bis zum nächsten Mal. Ciao.